Hey, Navy Dowdy, coming to you from the Chicago area here in the great Midwest in the fabulous United States. Are you worried about the new 10-year rule? That rule now requires beneficiaries of inherited IRAs to withdraw the entire balance and pay the tax within 10 years. You can double that time with a CRT, or a charitable remainder trust beneficiary, that you put in front of your non-spouse beneficiaries. And remember, your beneficiaries are likely to inherit your retirement accounts right when they are in their highest tax brackets. What if you have a really big IRA and the 10-year rule just isn't enough of a stretch to help your beneficiaries stay out of the top tax bracket? Or, for that matter, for any other reason that you care about reducing the negative tax impact from the 10-year rule. You could use some of the other remaining tax rules to your benefit by setting up, for instance, a charitable remainder trust. Just one of the many ways to accomplish this. A charitable trust allows the retirement assets to continue growing tax deferred even once the assets are distributed from the retirement account into that charitable trust. Tax is paid only when the trust distributes some of the income to the beneficiary, who is often a child or other non-charitable beneficiary. There is no tax if it distributes the assets to a charity. Essentially, the charitable trust creates the ability to regain the benefits of a stretch IRA. The charity is involved at the passing of the initial non-charitable beneficiary, but it can also occur at the end of a term, for example, 20 years from the account owner's passing. Whether it is at the end of the beneficiary's life or a term, the charity receives the balance of the trust assets at that time. The only requirement is that the trust is designed to leave a 10% of the initial contribution to charity. Can you see how doing what we always recommend, combining strategies together in the right sequence, can provide much more income for your family? The IRS zigs and the planners zag, and we all march on with one common truth. People who meet with tax planners are the winners, and people who do not often lose out. Plan your tax outcomes, or use the IRS's plan, which probably won't be as good for you and your family. I'm Navy Dowdy, and remember, financial fitness can be beneficial to your wealth.